So the budget's out and speculation is over, and most people think it's a disaster. In fact, there's some people that are saying that, investment properties are going to now plummet for like 50, 60, 80%. The whole thing is world's going to collapse and we're going to be eating bread and 2-minute noodles for the rest of our lives. Listen, the reality is that's not the way things work for a couple of reasons. So I thought it makes sense to do a video and talk about the reality of the budget, particularly for property. There's a whole bunch of other things in the budget. They're throwing money at young people and giving them $1,000, hoping that people invest or whatever. And obviously, there's been incredibly good marketing around the budget. They've been calling it, a generational unfairness solving thing or other. Listen, it's a budget. The government needs the money, so they're basically using that. Luckily, though, the government was probably scared enough that they decided to make these particular measures, most of them start like 18 months from now or a little bit over a year from now. So that gives us a little bit of time. It also gives them a little bit of time to see how they're going to make all this stuff work. Is at the moment the budget is just a whole bunch of ideas. Now they have the numbers in Parliament, it's going to happen. But obviously the practicality of it will probably hit in the next year or so. And particularly the actual details, operational aspects will hit over the next year or so. But let's talk about the changes that got announced in last night's budget. It's pretty fresh, so not everything is quite super clear yet, but me and the team been analyzing the budget since it really got announced last night, and we have a pretty strong view, sometimes a controversial view, of what's about to happen and the implications for property investors more broadly. So let's go and cover those. I'm not gonna go and describe what the changes are and all of that. Listen, by now the whole internet is full of detailed rundowns of what the changes are and the winners and the losers, and just one turn the news for 5 minutes, you'll get a set of changes. I want to talk more about the second and third order consequences of each of those changes, and more importantly, how I am going to start managing my portfolio, maybe a little bit different as a consequence of those changes, to make sure that I limit the negative impact that it could have. Let's talk about the simple one and the easy one. So minimum tax for trusts. So what they're saying now is that trusts are now going to pay minimum 30% tax on their profits, which, by the way, doesn't mean that that's what they're going to pay. That's the minimum. You still get much higher taxes if you manage the trust the wrong way. And then what they're saying is if you do a distribution to an individual, then the tax that the trust already paid is going to be credited to the individual in their tax return. So that effectively means that for most individuals, there's not going to be any impact, particularly if you're already in the 30% bracket or above. So, if you're making over 48 grand, it's probably literally no impact to you. The big issue here is for corporate beneficiaries. That is when a trust makes a distribution to a company instead of making a distribution to an individual. It's very well known that a strategy of dealing with excess capital, if you don't need it immediately, is to distribute it from a trust to a company, so that way, the company pays 30% tax, and then that way, it gets sorted. The problem is the government thought that will be a loophole for people to distribute to a company that then can pay a dividend to an individual, and then through a system called franking credits, where individuals get recognition for the tax paid by the company, then effectively will undo the whole thing. So they well and truly threw out the baby with the bathwater. They kind of went and said, like, no, we don't want that loophole, so we're going to close the loophole, even though we're chopping an arm of the system in the process. And I think, listen, the message is pretty clear here. So trusts have been used in the country to provide asset protection, but also provide flexibility on how income is distributed, right? One day you can distribute yourself more money and your partner less money. The next year you can change all of those depending on how much money you're making, what's better for each, how much money you need, all of those things. The government is now seeing that as they're deliberately calling it tax avoidance, tax evasion, which I think it's a little bit of a stretch because the rules are made there. But they're definitely closing that option. And you can tell by the kind of trust that got impacted. Discretionary trust got impacted, but fixed trust, things like unit trust, did not fall into the same category. Now, we've been using trust for a long time, not only because it gives you flexibility on the distribution, but also because it gives you eligibility for the capital gain tax exemption or discount. We'll talk about that in a second, but that loophole is also closed. So what do I think is going to happen? The reality is trusts are an Australian thing. They don't really exist everywhere in the world. They exist in a few countries. In a few countries they exist, but are actually not even used all that much. In many countries, it's only companies. And I think that's the direction in which we're going. I think we're very, very, very quickly going to see a change from having things like properties in trusts to having properties in companies, particularly because a lot of the benefits of trust are literally evaporating as part of these changes. So if the changes get implemented the way they got announced yesterday, and obviously we don't have legislation yet, but then there'll be no use for trusts in a property investment. And in fact, it'll probably become a negative to use a trust in property investment. That said, there's other options. Like I said, you can put it on a company, you can achieve some of the same results in many ways. The jury is still out on how this whole thing's going to play out, but what's really going to happen here is the world's going to adapt. We're going to use whatever tools we have left. And in fact, the government has recognized that that's what's going to happen, because as part of the announcement, there's a couple of paragraphs that talk about small businesses are going to be allowed certain concessions and certain opportunity to exit the trust system and then go into other ways of structuring, most likely companies, but some people will also choose to maybe do things on their own or in a partnership or in some other structures. I'll probably be talking about structures a lot over the next year as I clarify with advisors and other fellow investors, what the best way is to proceed for my personal portfolio. And I'm very happy to be fully transparent and share that journey with you. So watch this space and we'll cover some of these very soon. Now, number 2, and I think this is the biggie, is capital gains tax. And in fact, it's probably one of the 2 biggies, to be fair, is the next one is probably going to have an even bigger impact in the property world in this country, even though it's not going to impact me absolutely at all. It's one of those big ones. But before we cover that one, let me talk to you about what's happening with capital gains tax. Now, again, I'm not going to go over the details of the announcement, but what's really happening is they're backtracking the changes that they made a bunch of years ago, where they simplified the system by saying, well, if you have an asset that you have kept for the long term, which it's defined usually as 12 months, then what we're going to do is, instead of taxing you for the whole of your gain, we're going to tax you for half of it. And that's to recognize that this is not regular income, that this is a capital gain of an asset that you have kept in the long run. It's an incentive for people to hold assets for the longer term. That's going away. What's going to happen now is going to go to a system that actually conceptually it's a lot easier to understand, but the reality is that in practice it's a lot harder to operate, which is they're going to go and now think about, well, we want to tax you on the gain. We absolutely will do that. However, we're going to recognize that we live in a world where there's inflation, and that if you bought a property a couple decades ago, you probably bought it significantly cheaper than what you will sell it for today. But that will not just be capital growth on the actual asset as part of, property becoming more expensive. Some of that will be just the fact that inflation has come through. So in a way, they're trying to avoid taxing you for the inflation. So what's really going to happen is you're going to take the value of the property when you bought it, or the value of when you sold it, and then you're going to take the value of the property when you bought it, and then you're going to apply the inflation rate of that year all the way along, which means that effectively you're only going to be taxed on the gain, on the full gain, on the total gain in real terms, which means that, all the inflation kind of happens for free. And I think what's really going to happen there is, and it is something we've done some modeling today to try to understand the thinking around this, is there's going to be winners and losers. I think a lot of people who will go and buy an asset, keep it for a year and 1 day, and then sell it just to get the capital gains tax, they're going to be really disappointed with this change. This is exactly the type of behavior that the government is trying to discourage. But people who hold assets for a long, long time might end up being better off, or for the first paragraph of the announcement, might end up being better off. Because effectively what happens is, when you get the 50% discount, you get it once, you get 50% and that's it. You don't get anything else, right? Whereas when you use inflation, even though inflation might be 3, 4, 5% over the years, the longer you have the asset, the more that inflation accumulates, which means that a bigger discount you get. So in theory, at least, at some point, you'll get a bigger discount by accumulating the indexation than potentially you will by just the 50% discount. Now, how much and when and at what point do you have an equilibrium? It really depends on the time and the property and and particularly years and how many of them have you kept this asset. I can guarantee you that if you kept an asset since 1983, you're probably better off with the indexation, although to be honest, you probably wouldn't even have capital gains tax then. But certainly, you'll probably be better off that way. And by the way, and no matter what happens, because we're not sure how to calculate this stuff, and maybe our forecasting is a little bit off still, the minimum tax on capital gains tax is going to be 30%. So doesn't matter indexation, doesn't matter anything else, doesn't matter how much of a profit you're making, or what, or how, or whom is receiving these capital gains, you'll be taxed at 30%. And why is that important? Well, I was talking just before about the fact that this budget will change the way we use structures. And in a way, will go and reduce the usability and the utility of using trusts in structuring, particularly for property. So what's effectively going to happen is capital gains tax is going to be a minimum 30%. Well, guess what? Companies pay 30%. So you may as well put your assets in a property, right? You are going to pay 30% flat. That means that you're going to pay at least 30%. You're going to pay no more, no less, but exactly 30%. Now, I know some companies pay 25%, particularly if they're active companies that are running businesses who have 80% or less of their income through passive means, which means that they have at least 20% active. That's completely irrelevant for this. You're going to pay 30%, right? Now, again, they've been softening these announcements to make sure that people don't panic by saying, hey, don't worry, it's all grandfathered, which means that any property that you own yesterday will not go through the new capital gains tax exemption or the new rules on capital gains tax. Sure, assuming you don't sell it, right? If you don't sell it, you keep the benefit of selling it, which it's a bit of an oxymoron. It's like, okay, well, what's really going to happen is assets are going to cycle over time and then they're going to be okay. Now, I don't sell my properties anyway, or at least I don't try to, unless someone convinces me pretty strongly of do that. So I think overall we are going to be okay. Now, the reality here is that this capital gains tax change, what's really going to do is it's going to have a big impact on the whole speculation versus long-term hold. What's really going to happen is people, hopefully, and certainly will be case, and I hope it's a case of you too, will start thinking about investments, particularly in property, with a longer-term view. I think if you have a long-term hold and you have no intention of getting rid of the property, particularly if it's a property that is putting money on your pocket every month, then the impact of this particular announcement around capital gains tax is going to be a lot less than it will be otherwise. But the key there is the property, has to be putting money on your pocket, ideally every month. And that's critical because of the third and last big bomb that got dropped yesterday, which I'll be honest, I'm astounded that this happened. This same government, this same party lost an election not long ago because they went to the election with this exact policy. And I think Australia voted very, very decisively against them. Now, we're not going to get that opportunity this time because I think we're 2 years from an election and we have short memory. And again, I don't know if it was on purpose or if it's just a coincidence, but because a lot of these changes start next year and the year after, what is really going to happen is there won't be enough time for the full consequences of these changes to flow through the economy and the property market, which means that, we might go to another election blindly, or worst, we might have gone to another election where all these announcements happened by then probably a couple of years ago and nothing bad has actually happened. But the key is whether it hasn't happened yet or whether it will never happen. I am of the view that eliminating negative gearing is going to do terrible damage to the property market in this country, even though I don't use negative gearing, even though I'm not a big supporter of negative gearing. Let's talk about the pragmatic reality of what's about to happen. In this country, most investors subsidize their tenants. And what I mean by that is the rent that they collect out of their properties is not enough to pay the expenses and the interest and the mortgage and everything else that needs to be paid when you own an investment property. But that's okay because we're going to let you use that as an offset of your other income. And because we're going to let you do that, which again is where the name negative gearing comes from, then a lot of people have gone like, I'm going to go and buy a property, I'm going to lose money every month, but that's okay because I'm going to save money on taxes. Now, obviously, we've been very, very vocal and we've been big advocates of not doing that. But the reality is that has effectively become an incentive to acquire properties where the rent doesn't cover the expenses. Now, what's going to happen now? Well, one of two things are going to happen in the long run. The first thing that I think is going to happen, and this is pure supply and demand dynamics that I remember learning back when I did my MBA a long, long time ago, is that the incentive to go and buy that type of property and rent it out at a loss is going to disappear. Now, the government has been very, very vocal that that's exactly why they're doing this. They're doing this because they're like, people cannot buy a house. Therefore, we're going to make it harder for investors to actually hold investment properties, i.e. we're going to make it a bad deal. Therefore, investors, not being dumb or stupid, are not going to buy these properties. And the government is hoping that then first-time home buyers and young people can go and buy them. But what no one has thought about, or maybe they're thought about and don't care, is that those houses, those investment properties today that belong to investors, today they're rented to somebody who probably cannot afford a house. It's actually paying effectively subsidized rent to live in those houses. Now, the government is saying that, that is going to allow young people to get a leg up. Well, listen, the reality is, unless we are creating a deliberate crash in the property market, the prices of the property are what the prices of the property are. And if you cannot afford it today, and now there's not going to be any rentals around, then I'm not entirely sure what the game we're playing here is. But the sinister part of it is, again, supply and demand say that once few of those investors retreat, or once the grandfathering for negative properties is not there anymore, what will happen is now investors who have these assets, who are renting these properties to tenants, are going to try to cover the gap somehow because they won't be able to recover some of that loss from their taxes. So what do you think is going to happen? Rents are probably going to go up if I had to bet. I don't have a crystal ball, so I don't know what's going to happen. And obviously everything I'm saying is pure speculation based on my pragmatic view of the world. But I can tell you right now that as a consequence of this, rents are certainly not going to go down. And the prices of property, whether they're going to move or not, then like I said, I think it's very, very unlikely that current investors are going to exit the market because again, they will lose their grandfathering of their negative gearing and their capital gains tax if they do so. Now the government has gone like, no, we still think supply is important. So new properties are unaffected, right? We're not going to touch new properties because new properties are important. So if you buy a new property, you're allowed to negative gear. If you buy a new property, you also get, some kind of benefits around capital gains. You'll be able to choose your freedom, pick which of the two methods you want to use. However, the problem with doing that is unless you're buying a new property to never, ever, ever sell it again, the value of that property to the next person, the value of that property to the next investor who's going to buy it from you, it's going to be less because that second investor will not have negative gearing. That second investor will not have capital gains benefits. And in fact, under a change that was made many years ago, that second investor won't even get depreciation on fixtures like you do when it's a new property. More importantly, though, not only negative gearing is being abolished the way we know it, but the only way of offsetting the losses from rent or from a negative cash flow property, the only way of offsetting those losses is going to be to offset them with rental income or capital gains. Now, this is what I'm going to be watching this very, very carefully over the next year and a bit. Because if you have two investment properties owned by the same person or owned by the same entity, and they allow us to take one of those properties that is negative geared today, that we're claiming some of those losses against our income or against some other sources, and you can put that together with another investment property, and that investment property produces a profit, and they allow you to take these losses and these profits and put them together and offset them against each other, then there is ways of navigating this whole negative gearing thing, which is the strategy that we've been talking to some of our clients already implement, and we have implemented in the past, where if you have a negative gear portfolio and you're losing money every month, you put one or two or a couple of positively geared properties, say a rooming house, and then in that case, you can literally hold the original asset without necessarily incurring a net loss at the end of the process. That will actually, if that door stays open, then that will allow normal investors to continue investing in properties pretty much the way we do it today, but only really smart investors who can structure these portfolios that way. So I think those are the major things to kind of bear in mind. That's probably the first contribution that I have to make to this debate, which will probably, like I said, continue for the next year or two, not only as these measures come into effect, but also as the actual real impact of those measures gets kind of observed over the next couple of years. The reality is the world will continue to change, the rules will continue to change, and we as investors need to know that we live in a world where the rules evolve. This is people are expecting that this will be, like test cricket, where, the rules are protected and they never have changed in hundreds of years. That's not the way this works. This is more like Formula One, where every year there's a new set of rules and teams adapt to those rules, and the teams that adapt to those rules better and that use the rules to their advantage in intelligent and smart ways, then they can continue to advance. And they're the ones who win the races and win the championships and reap the rewards. So stay tuned. I'm pretty sure there'll be more that we say about this soon. But in the meanwhile, let me know. What do you think? Do you think this is all, hot air and nothing is really going to change? Do you think this is the end of the world and property is about to collapse like it has in other countries? It'll be very interesting to hear your opinion, and I'll talk to many of you very, very soon.